So while he's doing that, I guess I'll start off with how this conversation is going to be a little bit different. As investors, I'll commend you all because you've all come here to learn about things that exist outside the public sphere, predominantly in private markets. Most of what you've heard about is venture. I'm going to talk about a few other things, and we're going to go really fast. I'm going to cover a lot of data. The idea here is to make you aware of thematics that exist and start a conversation with either myself, Preston, or Mark here in the back of the room throughout the conference to talk about some of the things that are just changing in the environment that you invest in. So I would imagine here that essentially everybody has a public markets portfolio. We're going to talk about what that looks like. We're going to talk about what it does for you today versus what it did for you in the past and how the math and the economics in that are changing, and identify 4 themes that you simply cannot ignore that are actionable now in private markets. Okay. So in doing that, we're going to look at some data. We're going to talk about optimizing portfolios. We're going to look at these non-correlated thematics. And most importantly, we're going to tell you where we're investing our money today. So if you look at the S&P, 30% of the S&P is trading at 10 times sales or higher. This has never happened in history. You look at valuations, you have 60% of the S&P trading at more than 30 times earnings, with over 60 of it trading at 30 plus. And this does not count the companies that don't make money. They're excluded from the indices. If you look at the concentration, this is actually 4 days old. It's actually 41% today of the S&P is concentrated into 10 names. If you look at what those names have done historically in drawdowns, you don't have to go back too far. 39 months ago, you saw the first example of this. Pretty volatile. Now, the natural inclination would be to say there's thousands of stocks here in the United States. You don't have to buy these 10 stocks. What does this have to do with my portfolio? I'm diversified. The reality is we're not. So I'll give you a few examples of this. I've been in the industry now 20 years. When I started, we were told modern portfolio theory, efficient capital markets, all of these things. So we're having some trouble with the slides. Clicking. Okay, here we go. We have different ones on. Okay. So we were told that if you invest in markets across diversified portfolios, things that don't have anything to do with each other, you will be protected. Things zig and zag at different times. What this data shows is the 20 quarters ended 2005 across broad categories of investment styles with thousands of funds inside each of these investment styles. And what you'll see is in correlation, some have strongly negative correlation with the S&P 500, some have strongly positive correlation, some have no correlation at all. The average 20 years ago was a cross correlation of a 0.16. Does anybody want to guess what that is today? So the first thing I'll point out is there are no longer any negative correlations. The strongest disparity you have is a 0.5 positive correlation. The average is actually closer to 0.7. But like most of you, most folks don't care about correlation when everything goes up. They care about correlation when things go down, periods of distress. In the periods of distress, this increases further to almost 0.8. And again, you have almost no disparity between what once was widely disparate asset classes. Reasons for this are multiple. One, there's a lot fewer public companies than there used to be. It's about 3,900 versus just south of 8,100 30 years ago. And people say that's fine. There are still all sorts of different styles of companies to invest in. We have large companies, we have medium-sized companies, we have small companies, we have value orientation, growth orientation. And they see their investment landscape looking something like this. It no longer does. It looks like this. And what gets even scarier is if you look at the cross correlation between all of these categories, they're essentially perfect today. So they are so perfect, in fact, that Russell has to recategorize companies that were exclusively categorized as growth into value to even have indices that exist today. So across all of the US equity style boxes, you're going to see this. The strongest correlation you're going to see in private world is venture. So if you think about building a portfolio, the tools that you used to use to get past this just don't. So you got to figure out a different way. Part of the reason for this is the ETFing of everything. There were all sorts of asset classes, particularly municipal bonds, treasuries, things that had no correlation to equities that were traded over the counter that are now traded in equity wrappers. They're systematically traded. They have trailing stops. They have all the technical indicators in the index construction that you have in equities. The more money that goes into these vehicles, the higher the correlation to equity becomes. You lose the diversification benefit. And essentially all that happens is instead of extending up the efficient frontier and getting more units of return for additional risk, you now just exist out here to the right, where you're taking on more risk for no return. So there's got to be a better way to do this, and there is. And that winning strategy is predominantly coming into private markets. So we're going to hit on 4 themes. I'll show you where they live really quickly on the efficient frontier, and then we're going to talk about why we are excited about them. So professional sports, GP stakes, which is actually owning pieces of private asset managers, venture capital, portions of the venture capital market that we're investing in very strongly today. And then the last piece here we'll talk about is energy, which powers every single thing you've heard every single person talk about here this week. So from a risk and return standpoint, a couple things happen when you add these asset classes. 1, you do get increased return. 2, you do get decreased risk. But these assets actually aren't correlated to public equities, and they're also not correlated to each other. So the portfolio construction benefits you used to get in public markets still exist in private markets today. You just have to know where to go and look for them. So if you think about your traditional 60/40 portfolio, this should be shocking for anybody that runs a family office or manages money professionally. A 60/40 portfolio today now has a standard deviation of almost 12. The S&P has a standard deviation of 12. That means adding bonds, diluting your returns, adds no benefit to diversification. If you look at even a small allocation to alternatives, 20% allocation, you're going to see the efficient frontier move up and to the left, and a 40% allocation reduces your vol by 40%, reduces your correlation by north of 60, while increasing your returns by almost 40%. The other thing that folks are worried about today are drawdowns. So over the past decade, we've seen the zig and zag of stocks and bonds stop working. These are average drawdowns at 10% or more in the S&P 500. What you'll notice is for the first time in history, bonds are negative at the same time over these same averages. If you look at what happens in private asset classes, you'll see disparate returns, more muted on the downside when down, but in aggregate, in a blended portfolio of private market investments, you're going to see these look materially different and post a positive return. So what we do, Hookaz, is we're a principal investor. We look for thematics we think are going to play out around the world. We invest the first dollar in, and we're typically the largest investor in everything we do. We have about $1 billion of our own capital invested. Once we identify a theme, we find the best way to exploit that theme globally. Most of that is managed outside of house. We then go to our network, which is 10,000 individuals like yourselves that run family offices, they're institutional investors, what have you. And we combine our capital to do 2 things. 1, get access to things we never could access on our own. And 2, create structures to deliver enormous economic advantage to you all. Is there any way we can speed up this? Okay. All right. So we're going to hit these themes quickly and then obviously, hopefully, have conversations with all of you. So the changing consumer. This is one of the largest themes that we think is hitting the market today and has essentially no correlation to anything else. If you think, when's the last time anyone here voluntarily started paying for new cable TV service, I would challenge anybody to recall that date and time. If you recall, what you have done recently is predominantly cutting pay service, and it's going to streaming services. Now, what happens in that environment is it changes where live eyeballs are. 20 years ago, if you looked at live eyeballs on media nationally, 14 of the top 100 for the event were sports. Today, it is 96. This is the single largest trend in media consumption, period. If you think about why media assets, namely professional sports teams, are expanding in valuations, it's not because they're trading at higher multiples. They have higher media dollars chasing that asset. Period. End of story. Full stop. This is not something that is going to stop soon. If you look at how these have done, they've actually done better than equities. And this is before professional involvement in these businesses. The growth of private markets. Private markets are growing. They have very low correlation to public markets. Our philosophy is very simple. Traditionally, if you are a private markets investor, you become a limited partner in somebody else's fund. Why do you do that? You do that because private markets have outperformed public markets for a very long time. So when you join a fund, what do? You pay the 2 and 20. A GP starts a fund, you're an LP, you invest in it. That's very good. If you pick the right horse, you make a lot of money. We would prefer to own the racetrack. And what that means is we actually buy a stake of the GP who is offering the fund to investors. We get a portion of the management fees they charge when things are moving sideways or down. That's asymmetric in our favor. And when they make a lot of money, we get a percentage of the carry, also asymmetric in our favor. And the one that I'll end on before we get into the group here, because I know we're running out of time, is energy. For non-economic reasons, there has been a lack of institutional capital following energy assets in this country for 12 of the last 16 years. This is not sustainable. This is the best risk reward we have seen in private markets, period, in the 30 years that we've been professionally investing. And I'll show you a couple slides that you can take pictures of. We can also make this available to all of you after this. Generally, there's a perception that we replace energy sources. We do not now, nor have we ever, replaced a single energy source anywhere in the world. To put that another way, we are still burning more dung for warmth than we have at any point in human history. And the reason is the expansion in energy resources that we need. So what's on this slide are all of the sources that are publicly tracked for major contribution to energy demand in the United States and the CAGR over the next 25 years as far as what's expected. So what this leads to is scarcity. Just in the next 5 years, from AI data centers alone, we will need power demand for 6 new New York cities. And quite simply, we cannot get there. Typically, when you have scarcity, you have high prices. We talked about 60% of the S&P trading at 30 times earnings or higher. We are buying upstream energy assets today in the United States at 3.5 times earnings. Let me put that another way. That's a 28% cash on cash yield day one on assets, and we cannot replace them. Scarcity and prices like that will not last. The last thing we'll talk about is space and defense. This is our venture sleeve. You've all seen it in the theater overseas currently. We do not have the capability to really embrace modern warfare with the technology that we've had. You've also seen all the commentary on NATO and defense spending that's going to come. There is a major renewal cycle that will happen in this space. It is funded irrelevant of political party, irrelevant of economic cycle. This money will be spent. So to capitalize on these themes, and I see a lot of people taking pictures, we'll make these all available to you. You have a few options. One, if you have access, you can go out and try to build these things on your own. Two, if there's a single thematic that makes sense for you, come talk to us. You can invest with us alongside our personal capital. Or if you're interested in more simplicity, we have vehicles that do all this for you all in one. So appreciate the time. Look forward to engaging with you all. And hopefully I finished on time. And are there time for questions?
Right on time. Harvey, we're finished. So
Okay,
thank you so
sounds
much.
good.
Great job.